But you need to take a look in your house and everything inside your house. Look at all those brands. Earnings are coming down 25% for everything that you see because no one's buying homes. And when you buy homes, I mean, that's one of the biggest drivers of GDP because everyone buys so much stuff. I know I'm building a home. Everybody's buying stuff, buying new stuff, and you're going to see whatever it is. If it's just furniture, electronics, TVs, all the stuff. I mean, please wait till Black Friday to buy anything. I told you, you're going to get a 70-inch TV and get one for free. Buy one, get one free. I mean, that's how much inventory is on the levels for these companies. But that's a frozen market now. And so where am I getting to? So you see Delta, you see Pepsi. Pepsi's up a little bit. Okay, good. You decide to buy those. But let's talk about AMAT, Applied Materials, right? So this is a semiconductor company. Let me see if I can bring it up here. Because this is a semiconductor company that's down tremendously. And I want to try to show this to you. So Applied Materials, it's $77. Okay. And they came out and just had earnings. The stock was $167 at its peak. Okay, 52-week range. It's 77 now. Okay, it's up a tiny bit today, but it reported yesterday, and the stock got hit. I think it got hit by like 4 or 5%. And the stock got nailed, and actually even more than that. But the stock got nailed because they lowered earnings by, you know how much? 25%. They lowered earnings, and they said, oh, well, we're kind of on that list where, the U.S. list and, the semiconductor, we can't supply China. And so that's what they blamed it on. When you're looking at technology companies across the board, you have to lower their earnings expectations by 25% each. And they're not even close to being lowered. They're lowered by 10% right now. And that's the danger, where we're going to see earnings come in and they might beat. You might say, oh, well, earnings are beating and earnings are doing okay right now. They're beating because they lowered estimates tremendously. But they didn't even lower them enough because you look at Applied Materials, just one, you're going to see this across the board. We're seeing it with AMD. AMD was honest enough to come out and say, hey, you know what? We're seeing a massive slowdown in PC demand. Because if these companies are blaming supply chain concerns, you're crazy. I mean, it's not supply chain. I mean, you're seeing it open up more than prices are down 80% for long distance for travel when it comes from the West Coast to China. It's down 80%. You're seeing this market free up. It's more free than it's ever been post-COVID right now, the supply chains. So they can't blame the supply. If they blame the supply chains on their earnings, you should short them right away. It's not that. It's demand destruction. And that's what you have to pay attention to because you're going to see companies try to sugarcoat it. This isn't the time to sugarcoat it. Ford's been trying to sugarcoat it. I warned you about that. That stock got killed. Disney was sugarcoated. I warned you about that because shit was much, much worse than they're saying. And even Disney, I saw yesterday in earnings, you have to pay attention to this, guys, because Disney came out, Daniel.
Your favorite whipping boy.
They're going to come out. Just to be honest, that's why I'm pissed. But Disney came out. They didn't come out, but JP Morgan, you're seeing companies lower estimates under the radar. You guys don't see that because they don't really report that in the media. We see it because this is our job to see it. We see that like as these things come out. So JP Morgan lowered their estimates for 2023 from like 510 to 440. And then they lowered their target price. I mean, that is massive. And that's not even close enough because they're going to go much, much lower than that. But I mean, they didn't know, like, you'll see like adjustments of 510 and, oh, we think subscriber growth might be a little bit bad. And for streaming subscribers, and we're going to lower it to $5 to $4.40. So when you see Disney report and they beat the number, just know that number was like 510. And when this number is probably going to be 430. So when they put 435, you'll be like, wow, Disney's doing great. Okay. No, they're not. It shows that the stock is not trading at what they're telling you 15 times forward earnings. It's really trading well over 20 times forward earnings. And you don't deserve that premium because earnings aren't growing year over year. For most of these companies, they're declining sharply and they need to come down. And that's what you have to worry about. That's a big risk. That's what the Fed's are causing right now. And they're going to continue to do it. It's bad now. It's going to get even worse next year. And that's why you got to prepare. You got to be very careful, guys. This is a really, really crazy market. And just, again, we took JetBlue, right? Is a risk reward there? Do you want to come out and pick that thing and say, hey, I'm going to buy at the low before the quarter and get 1%?
JetBlue, Delta. Sorry, JetBlue.
That's
the New York in you.
I hate
JetBlue.
JetBlue.
The Northeast.
You know what? I don't
think I've ever flown JetBlue.
Don't fly JetBlue.
Don't do it.
It's terrible. It's horrible. I mean, I think they're like the newest airline, and which is funny, and they basically have the same fleet for like 25 years now, whenever they came out. And it's like, you remember that it was the best thing ever because you had this little TV and it was direct TV. Like, holy shit, I can watch TV. I'm like, now that everybody can. And that TV works on like half the slots now because they never replaced it or whatever. So it's like, oh my God, it's such a nightmare. But anyway, it's like, their hub is in JFK. So a lot of people they don't like flying it, but they kind of have to fly it. Right. So anyway, but Delta I'm talking about. Yes. Thanks.
So with earnings season, I would expect a lot of companies to take the route of FedEx and not give forward guidance. What say you, Frank? Because to your point on risk reward delta, hey, solid numbers. You're not really getting that big of a pop. Granted, it's good to see that during a crazy day, volatile day in the markets. However, if you're a CEO outside of tech, because tech's going to be really tough, what risk reward do you have to give guidance? I mean, selfishly.
Well, I mean, the risk is if you don't give guidance, your stock's going to get nailed.
Right.
Even though it's down 30%, it'll fall 15%. Because now you can't, the analysts don't know. And we know what happens when you have uncertainty, right? When you don't know is, you're supposed to earn $7 a share. And if you bring it down to $5, people could adjust their estimates and be like, okay, well, you're already down. The stock's down 35%. Maybe it goes down another 5-10% here. Okay. If you really can report that, and cut costs and maybe get a little bit better and go to 530, that's okay. But when you remove guidance, is it 4? Is it 3? Is it 2?
Right.
Right. So that's the uncertainty. That's the risk. You're going to see companies like Pepsi, like Coke, some of the food companies. I think they're able to get some sort of guidance. If you're a technology company, holy shit. I mean, you don't, most of their profits come from overseas and the dollar's at 20-year plus highs across the board against basket of currencies. Their earnings are going to collapse just for that. Already we saw a company come out. I forgot, even Pepsi came out, right? They have big international operations and said, based on constant currency, that's what you're going to see. You didn't see that at all for a while, for 12 years. But now they say constant currency because, meaning that, the money's not going to be worth a lot more. And I talked about this. I talked about this on yesterday's podcast before the whole freaking building went out and we were sitting in the dark. But I learned this the hard way in 2012. I'm pretty sure that's when the last time the Canadian dollar was on par with the US dollar, pretty close, I think, 2011, 2012. And, I had a lot of private placements and stuff. And now there was a huge differential. Now it was 30%, it's probably like 35, 40% now differential. And I realized it because I'm like, hey, I cashed out of one of my positions. And when I got my money, it was 40% less. I was like, whoa. I paid for this in cash and they converted it to Canadian at the same level. You don't realize until it happens to you how big of a deal that is. I mean, so that's one thing. Throw in demand destruction where China still, the growth engine of the world. I mean, what's their GDP? Do you know by any chance? I don't know if you look it up. I mean, this is a country that's growing by 8%. 9% and always out there now, with COVID and the problems that they have in there. So, I mean, I don't know what China's GDP is now. I'm going to try to figure it out, but let's see if I can bring
There's
it up.
Another data point to take with some salt.
Yeah, but exactly.
But you got to go off what you have to play by the rules you're in.
Exactly. So, it's just, where's the growth coming from? I mean, I don't know. I don't know where the growth is coming from. So I have no idea. And where's the buying coming from? And you're more inclined to think, wow, the stock market's down. It always goes higher and higher. It's different this time. It went higher and higher because this isn't, Daniel, this isn't a COVID problem where we injected $11 trillion. That's part of it. This is a problem since 2008. We kept interest rates low forever and we never paid the piper. Because the biggest thing that I've always said this, that the worst thing that happened during that time when we bailed out banks and we know that they had to do that or you weren't going to get your money out of banks. Unemployment went 30%. What happened to Lehman could have happened to the whole system. They just chose Lehman. It wasn't like Lehman did anything different from anybody else. They just said, hey, let's let these guys fail and see what happens. And look what happened. They were like, holy shit. They thought it was going to be good and it wasn't. They could have picked anybody to do that outside of JP Morgan who would have got destroyed. They were all leveraged at 30x. But the worst thing that happened during that time, Daniel, was that the government made a fortune on everybody that they bailed out. And that was because now they feel like, wow, we could spend as much money as I can. The economy's going to come back. So you have all of this where, 0% interest rates, we might not see that for another 5 years. I mean, unless the only way we're going to see levels go down to that level is if the markets absolutely crash. And, we see inflation fall and the markets continue to crash. When we look at the market, the only comparable market I could think of, because you look at 2008, the crash was pretty quick. I mean, it started bouncing back in 2008 towards the end of the year and then crashed again. And then bottomed out, but it wasn't that long. COVID came back, 2 months? March, April, boom, that's all. A huge 30% decline came back because you have the Fed there to pick you up with 0% interest rates. But let's look at the NASDAQ crash, the tech bubble in 2000. I mean, you're looking at 3 years where the Fed lowered rates incredibly all through 2001, like 10 times at 25 basis points to 50 basis points, and then lowered 2002, lowered 2003. That whole period from March 2000 when the market started to crash, it kept going down for 2.5 years before you finally bottomed. I mean, and that's what we need to, that's what the Fed is doing. And we have to be very, very careful to look at our earnings and say, wow, things are cheap now. And I heard it 50 times, dang, holy shit. 50 times on TV from analysts. Wow, well, a lot of it's priced in and it's cheap trading at 15 times forward earnings. Well, what earnings do you base it on? Because I remember in 2019, the total amount of earnings for S&P 500 was $160. Now they're expected for $240. How the hell did we get to that level if you're removing the $11 trillion that got us there? So if we're going from 240 to 160, do the math of how much of a decline. Maybe we don't go to 160. And by the way, we were at 160, Daniel, on the S&P 500 in 2019. You know what rates were? 1.75, below 2%. We're going to be at 4.5% next year.
Yeah.
I mean, you could argue that it's going to be below $160. And we couldn't grow earnings from 2018 to 2019. 2018, they grew tremendously because of Trump, and we had corporate tax cuts, massive. So we grew earnings like 25% that year. Now we have Biden that actually took some of that away. So that's another headwind that wasn't a big deal in a normal economy, but now you're adding that in, plus the dollar going higher. Holy shit. When I did this presentation, I sent it out to everybody, my family, my friends. I said, guys, watch this. And even the people, mentors and people smarter than me, I said, tell me where I'm wrong. And I haven't got any answers yet. I hope I'm wrong on this because most people are wrong.